And good morning. Welcome to Money Matters. Today is Monday morning. I am back in town. I am back in doing this stuff. My name is Nev. We do this show every morning live at 7 a.m. only on onedealaway.com. And I'm broadcasting out of Providence, Rhode Island. At least that's where I am right now. That's where I'm broadcasting most of the time. But every so often, if I travel, I take you with me and we go wherever it is that I go and we broadcast out of there. We look at the news, we cover what's going on in the world of money, of economics, and how, of course, we can benefit and learn from that stuff. Because it's not just about reading the news, it's what the news can teach us of how we can basically help ourselves not just survive, but potentially even thrive through this giant economic downshift that we're going into and potentially a boom years that we're going to see. But that all depends on what the Fed does, of what's going on, what happens. As you know, they're buying up everything, right? But there's some things that are saying that maybe that's not the right thing to do, and we've covered that actually when we talked last week. Hopefully, you have enjoyed the videos that I have created for you while I was gone this weekend. Anyways, let's do this. All right, y'all. Here we go. How are you? How was your weekend? I hope it was really, really good. And I want to actually go in. Sorry about that. So long story short, I was trying to adjust my um, I was trying to adjust everything while the stinger was going, and clearly I was not able to do that, and so you caught me like trying to adjust it. So if I made you dizzy, my sincere apologies. I'm gonna move this one more time. Close your eyes. All right, and okay, that one wasn't that bad, was it? All right, all right, all right. So let's switch over and let's take a look at the first thing. So Yahoo Finance, the reason that I'm looking at this, and of course, when I opened this, the first thing that I saw is why the stock market has gotten so expensive. Well, it's gotten so expensive because there's no revenue, right? And there is people buying the shares of stock, and so of course the earning per share are down, which makes the basically share very very expensive. That's sort of the bottom line of it, and it's trading basically the future expectations, not the reality of what's going on. And sometimes we tend to forget that that is the case, that that's what's going on. So I wanted to make sure I share that with you in case you're wondering of like what in the world. But that's not the reason why I opened this. I wanted to take a look at the S&P, the Dow, and the Nasdaq, and as you can see, the futures are on up, right? So there's that piece that it's still going up. I mean, it looks like it started slowly down, and we can take a look at it if you want. Let's take a quick look of what's going on. I mean, S&P futures, Dow futures, Nasdaq futures, Russell 2000 futures, it's all up. It's not up huge, but it is up. If we take a look at the 5 days, it was sort of kind of like sideways because we haven't talked in a while. So I wanted to take a look and see what's going on. Hmm. Gotta do coffee time. Coffee this early in the morning. I don't know why they put Sunday and stuff because it kind of slid down. But it looks like it's up for the morning. Okay, so that's the S&P 500. I want to take a look at the Russell. Russell is interesting because it's all of the small cap stuff. And so what ends up happening is that you get to see some of the bigger changes, bigger moves faster. And it's fascinating for that reason to kind of take a look at what's going on. So in a one day, of course, it's sort of, did pretty well until about 5 a.m. and sort of still green, but it's turning down. It's turning sideways. And I'm actually interested to see what the SP 500 actually did. now one I got something that I did not want to look at. Anyways, I can look at that another time. So let's switch over. Let's take a look at what's going on in the world of crypto. So here we go. Let's refresh because I haven't done that. And you know that this market changes so much that even if you don't refresh in the course of a minute, well, you might be late. You might be missing the whole thing, the whole shebang, as they say. All right, so here we go. Right here we have our top 8. We could probably actually look at the top even 11. I'm super excited to see the crypto.com coin is in the top 10. Uh, it's been flirting between the 11 and the 10 and stuff. Tether is definitely on the 3. It's, I don't know. I don't know what's going on. XRP, has dropped since we talked last time. So it looks like the market might have gone a bit lower since we have chatted. And let's take a look at the change in the 24 hours. Swissborg is out of this world. I mean, it's this is definitely an exponential return. Flexacoin, Digibyte, IOS, AVE, Ontology, Ren, all seem to be doing well. Celsius and VeChain, of course. So they're excellent returns over there. The sort of the downside, Compound down over 18%, but Compound also has been going up over the last, I don't know, 4 or 5 days, something like that. So it's like went from 80 to like over 300. Of course, he had to dump at some point, y'all. It has to do it. Golem, Horizon, ABBC, Loopring, Maker, Verge, Hedge. So those are the sort of the losers, or they have gone down in the price, in the dollar denominated price, as they like to say. And it's not, I mean, 3, 4, 5%. Yeah, it's big, but it's not big for crypto. That's for crypto, that's normal. But the interesting piece is that when you take a giant market cap, they're very small moves. A 0.5%, 1%, 2%, that kind of stuff. So as you can see, like when you take a look at over here, and I don't even worry about Tether because it's supposed to be flat, so there shouldn't be any changes happening anyways. As you can see, there's not a whole lot of like big changes. Chainlink at level 13 is the first one that actually has something more than 1%, right? Everything else is like very, very slow. So it's more or less sideways moving market. If we look at Bitcoin, I like to always look at the charts. As you know, charts are amazing because you can see so much more that you can't see anywhere else. So let's take a look at 7 days and take a look at what's going on. So it's almost like we've kind of hit this short-term low. You can see how it's coming down, and it's almost forming the sort of the nice little U, the gentle U, the cup. Uh, if we take a look at, I mean, 7 days, so that's only a week, right? So that's since last Monday. We went up, jumped, kind of came down. So I don't know. It'll be interesting. It'll be interesting to see kind of where it goes. I'm not a trader. I like to sort of do the long-term investing. But yeah, overall, I can see the pattern kind of has gone over. Now it's sort of going into accumulation, and out of that should actually take us back on up. Again, that could be fall, uh, because now, and the reason I say that, and this is not just for cryptos, but uh, one of the things that is interesting when it comes to trading anything, or investing in anything, is that during the summer the volume tends to slow down because it's summer, right? And so people are traveling, people are vacationing, people are doing stuff. They want to sit outside and relax and have a cider or margarita or whatever it is that they have, grill and do that kind of stuff, right? And so the kids are home, which I don't know, they've been home since March, so that doesn't cut it quite, right? But they were busy with schoolwork. And so anyways, it is very possible that we see a slower level of investing and trading and that kind of stuff happening over the summer months because of all of that. And then things will pick up like crazy come fall. Potentially. That's kind of how it goes, right? Uh, they have this whole saying like "sell in May and go away," or maybe I butchered it. I tend to butcher these sayings. So, but anyways, that's just one of the things to kind of pay attention to. So that's why I think fall is going to be much more interesting than now. And another reason for it is that right now, sorry y'all, my back is killing me, but did some physical labor, and now I'm paying for it. Anyways, with everybody being sort of cooped up, being allowed to go outside, right? I think that people are going to be more excited to go outside. Although, Robinhood does make it super easy to press button, buy, sell, and do that kind of stuff. So it might not necessarily completely slow down, but it wouldn't surprise me. Now, with people going out, there is a warning coming out of WHO, World Health Organization, that I was able to find, and here it is. So they're basically issuing a dire warning, and it's saying that we are entering a new and dangerous phase of the pandemic. And basically saying that because everybody's sort of fed up of being at home, they want to go outside. The countries are opening up, they're eager to open up, and people are starting to go out and about, and the virus is starting to spread yet again super, super, super fast. And so they're saying that the number of new cases reported were the most in a single day so far, 150,000. And he's saying that, folks need to exercise extreme vigilance. And we've seen this actually happen in, let's see, Arizona and Texas, right, have picked up a big deal. I just talked to my family, and so Serbia opened up. Now, this is not official. This is very underground, sort of unofficial thing. But I've talked to quite a few folks over from Serbia over the past few days, and the reports are that everything is open and everybody is running the same symptoms: low fever, having hard time breathing, sneezing, coughing, loss of smell, like all these different things. And so, what I think is happening is that Serbia is building a herd immunity, uh, which is really scary because, well, there's a good and the bad stuff to it, right? The good stuff to it is that you build an entire, the community builds an immunity to something and you can move on. The bad stuff part of it is that you lose the weakest members of the society, of the community, and so that's the part that it is kind of hard and harsh to deal with, right? And so that's kind of where we are and what's going on in that neck of the woods. I did hear as well that in New England, folks are starting to go visit Vermont, New Hampshire, Maine, uh, and coming out of woodwork. Uh, and those states are starting to pick up the number of cases as well. Probably not as high as Arizona and Texas because I haven't heard about it in news from others, but it is possible. So it is going to be interesting to see that, we've been talking about the second wave, and everybody's expecting a second wave to come in the fall. But it's interesting to see that it is summer, and it's almost like it's resurfacing. So whether you call it a second wave or you just call it that it is like first wave just coming back, um, it doesn't matter. That the point is that it is coming back, and it is interesting to pay attention to something like that right now. So I wanted to make sure that we cover that. Now let's jump over very quickly, share some of the stuff that I was able to find. Again, nothing earth shattering because we've talked about it before. But in case you missed it in the past, let's cover it right now. Eurozone economy is heading for a sharp decline of 13%. And Christine Lagarde is warning of major economic downturn in European Union, and it's saying there's going to be a surge of unemployment because they might not have seen it right now, but it's going to happen. And they're saying we're heading for a sharp decline and some 13% of the second quarter, and reiterate the bank's forecast of an 8.7% GDP drop in 2020 and rebound of 5.2 in 2021. Now, the drop, I can see it. I agree with it. I don't know. It's likely very close to real. The rebound is the part that I struggle with. Now, is that the rebound from the current level, or is that the rebound from the 8.7 down? Because if it's from the current level, right, like this is the part that it's kind of hard with this stuff that to understand. Because if it's from the current level, then that means that we're still going to be down, what, 3.5%, right? Uh, but if it's from the or sorry, if it's from the current level, it means that it's going to actually climb up like what, 13, 14%, which I don't think is going to be happening. But if it's from that negative 8.7% GDP, then I think it is possible. But that still means that we're down 3.5% from the 2019, early 2020 level. So the whole thing is very, very interesting. The one of the pieces that she is talking about is that the full economic impact from the pandemic has not been reflected in the labor market, and that because of the fiscal response to the pandemic, raising of the questions of ability to repay debts, different countries, different cultures, all tied to the exact same currency, and is saying that, this could revive the threat of countries leaving the euro and potentially the project breaking up. So that's kind of an interesting piece, sort of scary to look at it and read about it. And now we're going to jump into sort of a macro view of what's going on and what's happening with our money, with the economy. What can we expect? Where are we heading in this crazy, crazy world? So let's switch over. I'm gonna have a bit of coffee while you read the news line. Oh man, I'm almost out. Okay, so here we go. So we're gonna talk about a little bit about what's going on in the macro view, big picture view of the sales, the retail, the bounce. Are consumers coming? Are not consumers coming? Like, what is going on with this whole thing? So now what they're saying is that the consumer is the linchpin to the economy, comprising roughly 70% of economic growth. Most valuable thing about the consumer is that they are financially stupid. That's a bit harsh. I didn't write this, but this is a bit harsh. I might say that they are financially uneducated and uninformed, and I don't think it's the consumer's fault. I think that this was designed for a reason. There is a reason why none of us are taught about money in schools. The teachers don't teach you because they don't know. And I know that because I teach the teachers. Okay, so I know that because of that reason. So they don't know. Vast majority of them, they don't know. They can't teach it. Those that do know are not allowed to teach it because you have to follow a very scripted sort of what can or cannot happen, right? So you got to do that piece. So that's kind of where we are with the whole bit. So I wouldn't necessarily say that the consumer is financially stupid. I would say that they are financially left behind. They are financially uneducated because nobody spent time to educate them. And that's probably the reason why you're here, why you're watching this show, Money Matters, every morning at 7 a.m., because we cover some of the stuff that you maybe should know, you should be aware of, you should be paying attention to, but you don't even know it because nobody ever pointed it out, right? So that's the reason why we're doing these things. Consumers are also why companies spend billions on social media, personal influencers, blah, 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 because psychologically consumers are trained to shop, okay? And as long as they have a paycheck, they will spend it. So the basic premise is that the entire economy is built on consumers, basically meaning people have to constantly buy stuff, consume stuff, in order for the economy to keep on running. Now, that's the reason why we're also seeing things like smartphones, for example, breaking much faster now than before. A fridge is the same thing. Way back when, in 50s and 60s, you bought a fridge. That puppy ran to like 1990s. And I know that because my mother had it. Sorry, Mom. I pick on her endearingly, but she did. She had all of these technology, uh, electronics basically, that, were purchased, in the 60s and 70s or whatever, right? Like things, we've owned things that were like as old as like I am right now, right? And it worked, and it just needed a minor tweak. And you would have people that were actually appliance repair people that would come in and fix it. And the appliance repair actually cost less than buying a new one, so it made sense. But nowadays, we engineer breaking. We engineer the machine dying over the course of a few years, slowing down, uh, deteriorating. Then we keep the parts relatively expensive, right? And so between the parts being expensive and then the repairman being expensive, it costs you more to fix it than it does to buy a new one. And because technological advancement has moved on so quickly, we just basically dump the old, in with the new, and we move on. The unfortunate piece is that this lands in some sort of landfill somewhere, polluting the planet, which is, causing all of the challenges and issues. That's my argument, at least, or at least it's causing vast majority of them. They're going to sit in some sort of somewhere, never to degrade, right? And then the second part of it is that now you're having to buy stuff, and of course, you're spending more and more money. So there you go. That's kind of how the whole consumer piece is. Now, let's continue on. So now they're saying that there's a problem, that there's a consumer credit, and here's the what it looks like, right? So as long as people are getting paid and are able to borrow, they're going to be shopping. And we've seen what sort of looks like. Now this is looks like it tracks it down in the quarters. So it's '03 with the first quarter, and here we go. This is the 2020 first quarter. So you can see that right over here, this is the '08, '09 when it sort of tipped in. You can see 9 to 13 sort of slows down, but it didn't slow down drastically. So I think we can see it probably kind of slow down a little bit here as well. But I don't think that that's going to happen in 20, right? If it follows the same pattern, I can see that happening in 2022, 2023, because it takes a while to pay it off. So it takes a while for this to move. I mean, we're talking, 14.3 trillion? That's ridiculous. That's super, super high. And you can see what it is. Obviously, the biggest part of it is mortgage, but you will also see that student loan, which is this light over here where my mouse is. I'm going to move it out here so that you can see it. That's a student loan. And you see how small it was over here, and it sort of stayed, and then it started widening, and then it just took off. And I see that kind of continuing. I see that being the next sort of thing. Anyways, debt-driven consumption. So consumers are spending themselves further into debt is what keeps the stock market going higher. So right over here is what we're seeing. These charts are very, very interesting. But anyways, you can take a look. You see the S&P 500, right? Then you see the 10-year treasury, which is this guy right over here. I wish they used a little bit different colors because this is really hard to read. Uh, Personal savings rate, so that's this guy, as you can see, kind of dropped, but it sort of picked up. Then you have compensation of employee wage and salary accruals. As you can see, that actually has gone down. I mean, sort of side, and then it's down. So the wages are down. The savings is sort of kind of went up a little bit since the 2007 8, right? Which is nice. Um, S&P is definitely gone up. And so now they're saying that there's a consumption, household debt, and PCE as a percentage of GDP. My gosh. Okay. So you can see that he's saying that the consumers are spending themselves into further into debt is what keeps the stock market going. Well, duh. to move consumption from 61%. This is an interesting piece over here. So what they were saying is they wanted to move consumption, and to move it from 61 to 65% of GDP over the course of 20 years, so that's 4% move, it required 5.5 trillion in debt. Since 2000 to 2020, so 20 years again, to move it 3%, it required 11 trillion. So that's twice as much to move it, to move the consumption. So 4% in the first 20 years, right, from 80 to 2000, it took 5.5 trillion. To move it 3% from 2000 to 2020, it took 11 trillion. That is absolutely huge, and so that's the part of the problem. And so if we follow the same methodology, then that would basically say that from 2020 to 2040, to move the consumption again by, say, 3%, if it does double, indeed, that will require at least $22 trillion, which is basically annual income right now. Interesting. So, as you can see, we are coming to the precipice of something very, very big that absolutely has to change. It has to shift, and it has to transform in some sort of way. We don't know exactly what it's going to look like, but it's going to have to shift, because following the same thing, it just doesn't work. It hasn't worked in a very long time, and it's definitely not working right now. So let's take a look at the other stuff. Now, the gap between the standard of living and the disposable income is, here's the chart. And what they're saying is in 1990s, income alone were no longer able to meet the standard of living. So consumers turned to debt to close the gap. So prior to 1990, you could actually have a job, and that job will pay a salary that is very good, that will allow you to have a very, very good and solid lifestyle. That has shifted. Now, back in the, since I picked up my late mother earlier, when she was our age, so to speak, right, or younger, in the 60s and 50s and even 70s, even actually into the 80s, you could have a family. You could have one person working, regular job, and you could live very well out of that one income, one job. You could save, you could go on vacation, you could do all the different things. Since then, in the late 70s, into the 80s, and into the 90s, you could no longer do that. Now you had to have both people work in order to kind of keep up with it. In the 90s, you have to have both people work, plus you have to borrow. Now you have to have borrow, work, have another job, and potentially have the government pay you. That's kind of where we are. That's the world that financially has been built. And so that's the high problem with it. And, because you're, to keep up with ability to live a life, you have to borrow more. Well, when you have to borrow more, there's a big problem, because now that gap keeps on growing, you're never going to repay it. And so now, you just have to keep on rolling it over, which is exactly what the government is doing. The problem is that the government can print it in order to pay it. You and I can't. That's a giant problem with the whole piece. Now, they were looking at it and saying, well, what's going on with the whole recovery? Because we've heard the news that I've actually heard the news that said that no, consumers are back out. Everything is going back. This is amazing. Everything is back to normal. The sales are happening. So Ms. Shedlock has put in something that said, yeah, despite the surge, sales numbers are back to levels seen in 2015 and 2016. And here are the 5 months total. So total is negative. You will see that everything is negative except for a handful of things that I have highlighted. Building materials, food and beverage, and non-store retailers, right? Like Amazon, where you have to order everything. The only positive sectors were those directly related to the partial reopening. Stimulus checks are gone. More checks may be problematic and may not never come. Additional 600 in unemployment, it runs out next month, and all of it is stuck in basically the Congress, the House, the basically the political fiasco that is happening of them going back and forth. And at best, remember, they're going to go on summer vacation because they take vacations. I mean, they're like 3-year-old children that have to have break every 3 weeks. I got to take my vacation. I got to go on my recess. It doesn't matter that the economy is imploding, the country's falling apart. They're going to keep their income, their wealth, their investments, and their vacations. The rest of us, well, good luck, y'all. So that's kind of where it is. So we're going to be stuck, even if something was to happen. I don't expect to see anything happen right now. If we were to see it, I would say maybe late July. Maybe late July, maybe. And that's a big maybe, right? Next week we are entering what, like that 4th of July weekend. Forget it, man. Everything's going to shut down. Nobody's going to do anything. Everybody wants, fireworks and hot dogs and burgers. Although that actually sounds lovely. Well, I don't know about the fireworks, but the hot dogs and burgers sound lovely. Just kidding. All right. So, no getting back. Retail sales make up roughly 40% of personal consumption expenditures, which in turn comprise of roughly 70% gross domestic product, GDP. Now, what is also the problem is that when it was originally thought about, and originally when it happened, you can see from the 90s, it actually was going quite nicely along this line. It was quite nicely going this way, right? However, that has shifted in 2008, and you can see that the annual percent change in retail sales has actually dropped, and it's going at a slower pace. You can see how the gap is widening, right? Now we've seen this, and they're saying, oh, it's going to do this. But what if it doesn't, right? Like, what if it does something very different? And so that's going to be the part of it that I think that this is going to grow even further. And what they're saying is before the financial crisis, the economy had a linear growth trend of real GDP of 3.2%. Following the 2008 recession, the growth rate dropped to the exponential growth trend of roughly 2.2% instead of reducing the debt problems, unproductive debt, and leverage increased. And as you can see it right here, right? Hold on, let me scroll down. You can kind of see what's going on. Now, the other piece that is also happening is that when it comes to consumer and everything else, you also have to account for demographics. Because the reason for that is, that when you are 65 or 80, your purchasing is very different. You need food, you need medicine, maybe diapers, medical care, maybe newspaper, right? Like occasional eye check, like that kind of stuff, right? You're not going out there buying like the trendy shoes and clothes and hats and sunglasses. I mean, some do, fair, some do, but I'm looking at vast majority of them that don't. Whereas vast majority of 16 to 20-year-olds do that stuff. And, when you get into the 20 to 30, then you do the stuff with the cars and motorcycles and that kind of stuff. So a bit more expensive. Well, the problem is that we are aging. We're aging population, so we have more people, in their 70s and 80s than we do in their, teens. And so that's the problem. That's another reason why things are slowing down and are not going to pick up. And I can't remember whether this article has talked about it or not, but I figured that I mentioned that because that's a huge deal. Okay, now we have the economic employment problem. Those who are finding jobs continue to grow at a substantially slower pace than the growth rate of population. So while the jobs are being created, they're not growing as quickly, right? And the wages are also not happening. They're not growing. So there are over 26 million. This is according to the Bureau of Labor Statistics. that there are over 26 million people who are missing, according to the employment, how employment is calculated. So what they're basically saying is that it's incredibly important to say, well, this is what unemployment number is, but we also don't know where 26 million people are. What That is huge, though. That is huge. So, what is crucially important to the economy is full time employment, which creates enough income to expand economic growth. So, we have to have full time employment, and we have to have those revenue that the pay that the job, sorry, full time employment plus the income from the job that covers enough to be able to pay. Well, we've already discovered that it doesn't pay enough, right? And we're also discovering that there's not as many full time jobs happening because most people, if they have a job, it's a part time job. And so they have multiple part time jobs that are holding. So, as you can see, full time employment relative to working age population just took a nosedive, and we are at the lowest levels ever, like ever. If you don't have a job and primarily live on government support. So that's another piece that you have relying on the government, but when the government stops paying, now what? Where do we go now? I don't think that they can. I don't think that they will because like what do you do when that happens? You can't do much of anything. So anyways, with consumers forced to consume more on credit, which will lead to slower economic recovery as the ability to total additional credit becomes problematic, right? So you can see consumers are using more credit to consume, and you will see compensation. This is the part that we talked about. It's sort of going sideways and down. So that's really a problem. Then we have a tightening of the credit, and this chart is very, there's a lot of stuff going on it, but it's showing that basically because you earn less, you're borrowing more, your credit score is lower, and the banks are actually afraid. So now we're not lending nearly as much money as we should. So now we are sort of being faced with the problem from two sides. So we're being squeezed on both ends, as they say. So that's another piece. Now, in conclusion, okay, the economic destruction playing out in real time will eventually weigh on markets. There's a negative feedback loop between employment and consumption. And you can see, again, this is from 1960s all the way to 2020. This is a fabulous business operating against actual demand chart where you can take a look at. So you can see all the recessions, the gray lines. You can see fixed private investment, which is the sort of the dotted navy line. Employment, which is the green sort of pieces that you're seeing here. That looks like volume, right? PC year over year change, that's the blue one. The private non-residential fixed investments is the orange line, and the sort of the this is the year over year change. So that's the sort of the trend line. This kind of blackish again. It looks amazing from the design. From the readability and usability, it's very, very hard to read. So, but you can see overall is what I'm saying is that overall we've reached some sort of peak in the 70s and we're starting to get onto the decline. And one of the things that is interesting to note is that, for people that are into the precious metals and stuff, is that in the 70s is when we were taken off of the gold standard, and sort of has gone up and has been going down. So I don't know if it's related. People will say that it is. It is very possible. It is very likely. But it's also likely that we're just reaching the end of the entire financial and fiscal standard and situation. And I've been talking about that for a very long time. I don't know exactly what it's going to look like. My guess, or educated guess, is that it is going to be digital money. Whether it's going to be on a blockchain or not, I think it might, but it will be interesting to see. But it's definitely going to be digital money, and that's going to be coming over the next couple of years for sure, because what we currently have is not sustainable. People can only work so many jobs. People can borrow only so many things, and economy cannot grow at nauseum all the time. You cannot print yourself into wealth. You can borrow to get yourself there, but you're going to have to repay it and reshift it and change it. And so, while I do agree that you can actually borrow to get some assets to basically leverage and start creating basically what's called the productive debt, where you start earning more than you borrowed. The problem comes in is that if you overborrow and there's a shift in the economy where you don't make as much in the income, but you start losing money on the other end, then you find yourself in a problem. And I think that that's what we are as a world. So globally, that's what we are. So to conclude, we're just entering into what will likely be a more protracted, deeper, and more damaging recession than what we saw in 2008. I, Nev of Money Matters, am saying we're entering depression. Defaults and bankruptcies are only in the very early stages. Liquidity from the Fed has repaired credit spreads for the time being, and Federal Reserve did move quickly. However, those emergency measures don't translate into more robust economic prosperity. And Nev is adding here is that they might have acted quickly, but it's not enough. And now they're pausing, which is causing more problems. And once we see bigger, deeper problems, they're going to react again. And we're going to be playing this sort of game of math, cat and mouse, math and house, cat and mouse game that we're actually playing back and forth. And so, despite the bounce in retail sales, there will be no V-shaped recovery. And I think I agree with that. I've seen some of the stuff. I've been watching things. We are definitely slowing down. The markets are not, as you can see. We've looked at the markets. They are still going strong, as they say, but eventually things will have to sort of give up, and it will be interesting to kind of see it. So, personally, that's kind of where I stand. So, anyways, hopefully this is helpful to you and that you have learned something new and that you are positioning yourself correctly for something different to come. Tomorrow, we're going to be covering even more stuff of what's going on and how to protect yourself. Thank you for watching. Please do subscribe, hit the thumbs up, hit the bell, and join me tomorrow at 7 a.m. New York time, only on onedealaway.com. Until next time, stay forever money blessed, and do remember, you are only one deal away.